There is a corporation whose name you have probably encountered dozens of times without truly grasping what it represents. It sits quietly in the background of the financial system, rarely making headlines, rarely speaking loudly, yet shaping the global economy more forcefully than entire governments. This company, managing an astonishing $10 trillion in client assets, presides over a pool of capital larger than the total annual economic output of every country except the United States and China. That alone would make it extraordinary. But that is only the beginning. This institution is the single largest shareholder in the companies that define modern life. Apple, Microsoft, Amazon, Tesla, ExxonMobil, JP Morgan Chase, Pfizer, and hundreds more. Nearly every major American corporation carries the imprint of its ownership. Most people think they own shares in these companies through their retirement accounts or brokerage apps. But in reality, the shareholder votes attached to those shares are controlled not by the millions of individuals who paid for them, but by the asset managers who aggregate them. In practice, you don't own your shares. BlackRock votes them. And because voting determines who runs companies, what strategies they pursue, which mergers they approve, what policies they adopt, and even how much executives pay themselves, the institution casting those votes exercises a degree of economic influence unparalleled in modern capitalism. This company, of course, is BlackRock. It is not a bank. It does not take deposits. It does not lend money the way traditional banks do. Instead, it manages money for governments, pension plans, universities, insurance corporations, sovereign wealth funds, and ordinary individuals around the world. For this service, it charges tiny fees, fractions of a percent. But the volume of assets is so vast that even tiny percentages become rivers of revenue. But the raw number, $10 trillion, does not communicate the true scale of BlackRock's power. What makes BlackRock unique and far more influential than any financial institution that preceded it is the combination of 5 structural mechanisms. 1. Concentrated ownership across every major industry. 2. Control over shareholder voting and corporate governance. 3. A proprietary risk management supersystem called Aladdin. 4. Deep integration with government and regulators. 5. Unmatched access to financial information and market flows. Each of these mechanisms would, on its own, grant a company substantial influence. Together, they form a kind of financial gravitational field, invisible but inescapable, that pulls markets, corporations, and even public policy into alignment with BlackRock's incentives. To understand how this happened, we have to step back and understand what BlackRock truly is. Most people imagine it as a Wall Street giant, similar to Goldman Sachs or JP Morgan. But those are banks. They lend money, underwrite deals, and take financial risk directly onto their balance sheets. BlackRock does not. BlackRock is an asset manager, which means it invests money on behalf of others. Most of the capital it controls does not belong to BlackRock. It belongs to clients who have handed over investment authority, often unknowingly, in exchange for simplicity, low fees, and broad diversification. Over the past 3 decades, this business model, combined with a global shift toward passive index investing, transformed BlackRock from a small bond management outfit founded in 1988 into the most powerful force in world finance. Its origin story is almost ironic. Larry Fink, BlackRock's founder, was once a rising star bond trader at First Boston until he made a disastrous bet on mortgage-backed securities, costing the firm around $100 million. Fired and humiliated, Fink became obsessed with one idea. Risk must be visible before it becomes catastrophic. That obsession led him to build a system, a platform so advanced, so comprehensive, that it would eventually become the beating heart of modern asset management. He named it Aladdin. At first, Aladdin was simply a tool for understanding risk within BlackRock's own portfolios. But as BlackRock grew, and as financial markets became more complex, Aladdin expanded. Clients began requesting access to it. Soon it was no longer a tool used solely inside BlackRock. It became a product BlackRock sold to the rest of the financial world. Today, pension funds, sovereign wealth funds, insurance companies, and even BlackRock's competitors rely on Aladdin to analyze, model, and manage their portfolios. In other words, BlackRock's software runs a large portion of the global financial system. But BlackRock's rise didn't truly accelerate until 2009, when it purchased Barclays Global Investors, including its iShares ETF business. That single acquisition not only quadrupled BlackRock's size, it thrust the company into the center of a new revolution: passive index investing. Index funds track market benchmarks and buy shares mechanically, rather than through traditional stock picking. Investors flocked to these funds because they offered broad diversification at virtually zero cost. Billions of dollars began flowing into iShares every month, and with every dollar that entered an index fund, BlackRock's ownership stake in every major corporation grew, silently, automatically, inevitably. Here is the key insight. Index investing concentrates ownership. Because most index funds buy the same stocks in the same proportions, the three biggest asset managers, BlackRock, Vanguard, and State Street, end up owning enormous chunks of virtually every large company. This was not a conspiracy. It was a structural consequence of the way passive funds operate. And because index fund investors rarely vote their shares, the asset managers vote for them. This is where the power begins. Imagine a company like Apple. It has millions of shareholders, individuals, pension funds, mutual funds, ETFs. Yet the majority of them will never cast a single vote on a corporate resolution. But BlackRock will, Vanguard will, State Street will. And because they each own roughly 6 to 8% of Apple, they collectively control 20% or more of the vote. Now repeat that across the entire S&P 500, across airlines, banks, energy giants, pharmaceutical companies, retailers, technology giants, and you begin to see the architecture of modern corporate power. This structure is fundamentally different from historical monopolies. Standard Oil controlled one product. JP Morgan controlled a network of connected corporations. IG Farben controlled chemical production in 20th century Germany. But BlackRock controls ownership itself. And because ownership determines governance, strategy, and long-term direction, BlackRock's influence is not about managing companies directly. It is about shaping the frameworks within which companies operate. Nowhere is this more visible than in BlackRock's approach to proxy voting. When BlackRock casts millions of votes each year, it is not simply rubber-stamping management proposals. It is actively influencing how corporate America behaves, from executive compensation to environmental standards to diversity initiatives to merger approvals. Larry Fink's annual letters to CEOs sound like philosophical essays, but in practice they function as policy directives, and corporate America complies, not because Fink has legal authority, but because he controls votes. This is the quiet power of modern finance: influence without ownership, command without explicit control, governance through structure rather than coercion. But proxy power is only one mechanism. Aladdin, the software platform, is arguably more transformative. Aladdin processes staggering amounts of data, modeling risk across $21 trillion in assets. It analyzes every position, every derivative, every potential shock. And because so many institutions rely on it, Aladdin's recommendations create market-wide behavioral patterns. If Aladdin's models suggest reducing exposure to a certain sector, hundreds of funds may reduce exposure simultaneously, creating the very volatility the system predicted. This raises a profound question. If one system influences the decisions of the largest asset managers, pension funds, and insurers, is the market still truly free? Or is it a coordinated organism following a single algorithmic brain? BlackRock denies that Aladdin exerts such influence, insisting it is merely a tool. But the scale is impossible to ignore. When one analytical framework guides trillions in capital, the invisible hand of the market becomes less invisible and more algorithmic. Then there is the matter of BlackRock's relationship with government. During the COVID crisis of 2020, when markets were frozen and corporations faced insolvency, the Federal Reserve needed an institution capable of rapidly deploying emergency liquidity. They turned to BlackRock, not just as a contractor, but as the operator of key bailout programs. BlackRock was hired to purchase corporate bonds and ETFs on the Fed's behalf, including BlackRock's own ETFs. This was not illegal. It was not even unusual, given BlackRock's expertise, but it demonstrated something essential. BlackRock's scale makes it indispensable to government, and when a company becomes indispensable, it becomes untouchable. This revolving door between BlackRock and public institutions is not hypothetical. Senior BlackRock executives routinely move into high-ranking government positions and back again. Economic policy is shaped by people who just months earlier managed portfolios inside BlackRock. And then we arrive at the deepest mechanism of all, information asymmetry. Because BlackRock oversees $10 trillion, operates Aladdin over $21 trillion more, and maintains privileged communication channels with governments. It has a panoramic view of global finance that no other private institution possesses. It sees patterns before others do. It sees risks before others do. It sees opportunities before markets register them. This is not illegal insider information. It is structural omniscience, and omniscience is power. As we peel back the layers of BlackRock's influence, the picture grows more complex. The company's power is not merely the result of its size, but of how its size interacts with the very architecture of modern finance. To understand why BlackRock is not simply another large institution, but rather a systemic force, we need to examine the structural consequences of common ownership, proxy control, and algorithmic coordination. These elements blur the line between competition and cooperation in ways early antitrust thinkers could never have imagined. Traditional capitalism assumes rivalry. Airlines fight for passengers, banks fight for depositors, pharmaceutical companies fight for patents. But when the same set of shareholders own significant stakes in all major rivals, the logic of competition shifts. Companies still compete superficially, branding, advertising, public relations, but their dominant institutional owners have no incentive to encourage aggressive price wars or innovation that disrupts industry-wide profits. Instead, they prefer stability. Here is the core insight. BlackRock earns more when industries as a whole perform well, not when individual companies crush competitors. Thus, the entire economy drifts toward oligopoly, stable, predictable, profitable industries with limited competition. This is not conspiratorial. It is structural, mechanical, and mathematically predictable. Consider airlines. The major U.S. carriers, Delta, United, American, appear to be fierce competitors, but their largest shareholders are the same three asset managers. Multiple studies show that when common ownership rises, competition falls. Prices rise even when costs do not. Service quality stagnates. Airlines evolve into comfortable oligopolies rather than combatants. Now imagine this dynamic not in one industry, but in every industry. Banking, pharmaceuticals, technology, retail, energy, media, telecommunications. Everywhere you look, the same pattern emerges. BlackRock, Vanguard, and State Street quietly holding the largest blocks of shares. This leads to a phenomenon economists call soft coordination. Not explicit collusion, that would be illegal, but a subtle alignment of incentives. When the same institutional investors reward executives for maximizing industry-wide returns, corporate leaders intuitively avoid actions that hurt peers. The result is a marketplace that retains the appearance of competition, but loses its disruptive core. BlackRock insists it does not coordinate companies, but coordination isn't required when ownership structures naturally harmonize incentives. And nowhere is this influence more visible than in the realm of proxy voting. Every year, BlackRock casts millions of votes across thousands of corporations. These votes decide who sits on boards, and boards decide everything else. Boards hire CEOs, set compensation, approve mergers, determine investment strategy, choose how aggressively to compete, and define long-term priorities. When BlackRock supports or opposes a director, the impact is profound. Companies know this. Executives know this. Boards know this. A CEO may give press interviews about shareholder value, but the shareholder whose opinion matters most is not the millions of individuals pooling their savings into index funds. It is the handful of stewardship teams at BlackRock, Vanguard, and State Street who decide the votes. Larry Fink's annual letter to CEOs is a striking manifestation of this power. These letters are often interpreted as expressions of philosophical belief, but their true significance lies in the implicit authority behind them. When the man whose company votes 7% of every major corporation in America encourages companies to adopt climate disclosure standards, or diversity policies, or long-term strategy frameworks, those suggestions function as directives. This is governance at a scale the world has never seen. And yet the most formidable aspect of BlackRock's influence is not its ownership stakes or its proxy voting firepower. It is Aladdin, the algorithmic mind that analyzes and guides trillions of dollars in assets. Most people imagine investment decisions as a combination of human judgment and market forces, but in the 21st century, more and more of the financial system is governed by models. Aladdin models risk, correlations, stress scenarios, liquidity flows, and it does so continuously. It observes patterns no human can see, updates its assumptions in real time, and produces recommendations. The critical point is this: when enough institutions use the same model, the model becomes the market. If Aladdin tells dozens of funds to reduce exposure to a certain class of bonds, those bonds will fall, not because fundamentals changed, but because the model said they would. This self-reinforcing loop transforms risk management into a market-moving force. Aladdin, in effect, has become a meta player, not a participant, but the architecture through which participants act. And yet Aladdin remains proprietary. No outside regulator, academic, or policymaker has access to its algorithms. The system that influences trillions in capital operates as a sealed black box. It is impossible to overstate the systemic implications of this. In 2008, the global financial system nearly collapsed because banks relied on similar flawed assumptions about mortgage risk. Now imagine a world where trillions of dollars rely on the same risk engine, not by coincidence but by design. What happens when Aladdin misinterprets a signal? What happens if its models fail in an unexpected scenario? What happens when thousands of funds, all using Aladdin, take the same actions at the same time? This is not a hypothetical danger, it is a structural inevitability, and only one company controls the system. While Aladdin exerts invisible influence over markets, BlackRock's relationship with government gives it visible influence over policy. During the pandemic, when markets spiraled, the Federal Reserve turned to BlackRock because BlackRock possessed the operational infrastructure necessary to intervene quickly. But the decision had consequences. BlackRock was hired to purchase assets issued by BlackRock itself. The dual role, advisor and beneficiary, would be unthinkable in most regulatory contexts. But in finance, where speed is essential and scale is rare, the government had little choice. This established a precedent. In moments of crisis, BlackRock is the state's instrument. The relationship creates an ever-tightening bond. Policymakers come from BlackRock. Policymakers return to BlackRock. Issues like climate investment, international capital flows, sanctions, and monetary policy increasingly intersect with the expertise and interests of BlackRock executives. The revolving door is not corruption. It is alignment, and alignment creates influence. Then there is the matter of information, the most valuable asset in modern finance. BlackRock sees everything: capital flows, risk exposures, liquidity trends, geographical vulnerabilities, sector shifts. It sees client behavior aggregated across trillions of dollars. It sees early signals of panic or opportunity. This systemic vantage point gives BlackRock unique predictive power. It does not violate insider trading rules because the information is not tied to specific companies. It is tied to the entire system. But the difference is academic. Knowledge is power, and systemic knowledge is systemic power. As all of these forces converge, ownership, governance, algorithmic risk modeling, government influence, and information dominance, BlackRock evolves beyond the category of a mere financial institution. It becomes a structural institution, woven into the fabric of markets themselves. And this leads to one of the most disturbing elements of modern finance: circular ownership. BlackRock is a publicly traded company, yet its largest shareholders are other asset managers, Vanguard, State Street, which BlackRock in turn influences through shared ownership patterns across their portfolios. Each owns part of the other. Each invests in the same companies. Each votes in alignment on most corporate policies. This creates a triangular oligopoly, a self-reinforcing pyramid that governs the majority of corporate America. In previous eras, monopolies were broken when they concentrated too much power in a single company. Standard Oil was dismantled. AT&T was broken up. But the modern structure is different. No single entity owns a majority of anything. Instead, three entities own minority portions of everything, forming a de facto collective monopoly that is extremely difficult to regulate, because no one has absolute power, but together they have complete power. And the beneficiaries of this structure are predictable: Larry Fink, BlackRock shareholders, and institutional investors who enjoy rising asset prices. But the losers are equally predictable: consumers, small businesses, workers, citizens. Prices rise when competition fades. Innovation slows when corporations face no existential threats. Wages stagnate when labor markets consolidate. Democracy weakens when economic power centralizes. To understand where this is heading, consider one final trend: the rise of passive investing. Every year, more money flows into index funds. Every year, BlackRock's voting power grows. Every year, its influence deepens. By 2030, analysts expect passive funds to control the overwhelming majority of U.S. equities. By that point, BlackRock, Vanguard, and State Street will effectively govern corporate America, not through formal ownership, but through structural dominance. This is not capitalism, it is something new. A managerial oligarchy built on algorithms, index flows, and invisible influence. The question is not whether this system is powerful. The question is whether it is sustainable and whether it is compatible with democratic society. As passive investing continues to dominate global markets, a deeper philosophical transformation is taking place, one that fundamentally alters the meaning of ownership, competition, and even accountability. For centuries, the essence of capitalism rested on a simple premise: individuals and institutions who owned property wielded control over that property. But index investing severs ownership from control in a way that creates unprecedented concentration of power. When tens of millions of people invest in retirement accounts, they believe they are becoming shareholders, but in reality they become beneficiaries, while BlackRock becomes the controller. Your shares are held in street name, your voting rights are delegated by default, and your influence is effectively zero. You provide the capital. BlackRock provides the governance. This inversion of ownership is subtle, yet transformative. It shifts economic power upward, away from citizens and toward institutional stewards who answer only to themselves. And as this dynamic hardens, it reshapes the incentives of the entire corporate ecosystem. Managers increasingly cater not to dispersed shareholders, but to a handful of asset managers. These managers wield unified voting blocks far more powerful than any activist investor could ever dream of. In the 20th century, an activist might pressure a board by accumulating 2 or 3% of shares. Today, BlackRock casually possesses 3 times that amount in every major firm, not as an activist but as a permanent structural presence. This permanence gives BlackRock immense leverage. Unlike a hedge fund, it cannot be bought out, intimidated, or diluted. Its power is intrinsic. This has far-reaching implications for how corporations act. Companies now anticipate BlackRock's preferences. They adjust strategies, craft narratives, and design reporting frameworks not only for the market, but specifically for the stewardship teams that review their disclosures. If BlackRock emphasizes climate risk, companies begin issuing climate disclosure reports. If BlackRock emphasizes diversity metrics, companies publish diversity dashboards. If BlackRock emphasizes long-term governance, companies structure board committees accordingly. None of these actions are inherently good or bad. But what matters is that they arise not organically from the market, nor democratically from society, but from a single financial institution whose preferences become de facto policy. This is especially evident in mergers and acquisitions. Traditionally, M&A votes were among the most contentious in corporate governance. Competing shareholders would debate whether a merger made strategic sense, whether the price was fair, whether synergies were realistic. But today, with BlackRock, Vanguard, and State Street collectively controlling 20% or more of the vote, the outcome often depends on how these 3 firms decide. If they approve, the merger passes. If they oppose, the merger fails. Their perspective becomes the decisive factor, even when smaller shareholders dissent. This concentration of influence also distorts corporate behavior in unexpected ways. In sectors like pharmaceuticals, where competition strongly influences drug pricing, common ownership can inadvertently suppress the incentive to innovate. When all major rivals share the same top shareholders, aggressive moves that undermine industry-wide profitability become less attractive. The same logic applies to airlines, banks, and energy companies. Industries drift toward equilibrium rather than disruption. Entrepreneurs, once the engines of innovation, find themselves up against corporations shielded by trillion-dollar asset managers. A startup might develop a superior product, but competing against firms fortified by capital, scale, and institutional backing becomes nearly impossible. The landscape becomes less dynamic and more static. Oligopolies become the default market structure. Meanwhile, as passive funds expand, the mechanics of market pricing also change. Instead of prices being determined primarily by active analysis evaluations of revenue, profits, growth prospects, they increasingly move according to flows. When billions of dollars enter index funds, those funds automatically purchase shares of the same 500 or 1,000 companies. This raises their prices regardless of fundamentals. When flows reverse, the same stocks fall regardless of performance. This introduces a systemic vulnerability. Markets become sensitive not to information, but to direction of flows. And flow direction, in turn, is shaped by the behavior of millions of passive investors reacting to headlines, sentiment, or macroeconomic shifts. The structure becomes more fragile, not less. A downturn that triggers large redemptions from passive funds could create a self-reinforcing downward spiral, amplified by algorithms adjusting portfolios simultaneously. Aladdin, with its immense sophistication, attempts to stabilize this complexity, but by guiding behavior across institutions, it also synchronizes reactions. A synchronized market is efficient until it breaks. Then it breaks everywhere at once. What makes BlackRock's position even more unique is that its power is not only economic, but geopolitical. Countries rely on BlackRock to manage their sovereign wealth funds. Governments consult BlackRock on monetary stability, debt structuring, and pension reforms. International bodies seek BlackRock's insight on sustainability, climate frameworks, and financial integration. In moments of crisis, BlackRock becomes an unofficial extension of state capacity. In periods of calm, it becomes an architect of long-term strategy. This dual role blurs the line between public and private authority. When the same institution advises nations, governs corporate voting, manages risk models, and allocates capital, it becomes more than a market participant. It becomes a pillar of the global economic system. And yet the public remains unaware of the scale or nature of this influence. BlackRock operates quietly, avoiding media spectacle. Its branding is minimal. Its executives maintain a professional, apolitical aesthetic. It does not seek public adoration. It seeks stability, control, and growth, all of which thrive in silence. One of the world's most powerful institutions has no need for public visibility. Its power flows through capital, not charisma, through algorithms, not armies, through ownership, not office. This is a new kind of authority, soft, persistent, pervasive. Now consider the implications for democracy. When corporations shape public life, prices, wages, employment, innovation, and when those corporations take direction from a single unelected institution, who truly governs the economy? When index funds dilute the meaning of shareholder voice, who speaks for the millions whose capital fuels the machine? When financial giants own slices of every major company, how can any government meaningfully regulate industries without negotiating with the asset managers who effectively control them? This is not a collapse of democracy. It is a quiet rearrangement of power, shifting authority from elected bodies to financial stewards, from public debate to private analysis, from voters to algorithms. The system persists not because people chose it, but because millions of rational individuals made individually rational choices to buy low-fee index funds, to simplify investment decisions, to track the market rather than beat it. Rational choices at the micro level produced an irrational structure at the macro level, and BlackRock represents the pinnacle of that structure. Where does this lead? As passive investing approaches dominance, the market becomes a closed loop. The biggest companies remain the biggest because indexes allocate capital by size. Capital flows into them not because they are innovative, but because they are already large. New firms struggle to break in. Old firms remain entrenched. The economy ossifies. Meanwhile, policymakers rely increasingly on BlackRock's expertise. The next time a financial crisis emerges, whether driven by liquidity shocks, sovereign debt, or geopolitical conflict, the government will again need BlackRock's infrastructure. And each crisis reinforces the relationship. Each bailout deepens the dependency. There may come a time when BlackRock is not simply an asset manager, but an indispensable stabilizer of the global economy, when its models, funds, and governance structures become as necessary as central banking itself. At that point, the line between private corporation and public institution erodes entirely. Citizens will depend on a company they never chose, whose power they cannot vote on, whose influence they cannot limit, and whose actions are governed by fiduciary duty to investors rather than democratic accountability to society. And yet, this transition will unfold gradually, almost imperceptibly, through countless small decisions made for efficiency's sake. A pension fund chooses Aladdin because it is reliable. A corporation aligns with BlackRock's governance guidance to avoid conflict. A government hires BlackRock because no alternative has its scale. A consumer buys an index fund because it is simple and cheap. Individually logical, collectively transformative. The world BlackRock is shaping is not dystopian. It is orderly, efficient, and stable. But efficiency is not freedom. Stability is not democracy. Concentration is not capitalism. And once a system becomes this concentrated, it rarely decentralizes on its own. Monopolies do not voluntarily surrender power. Oligopolies do not dismantle themselves. Institutions built on trillions do not shrink. They grow. By the time society questions whether any single institution should hold such influence, the structure will already be entrenched. Dismantling it would be as complex as dismantling the electric grid or the internet. The deeper truth is this. BlackRock did not seize power. We handed it the keys through index investing, through delegation of voting rights, through reliance on its risk systems, through governmental outsourcing, through collective convenience. And as long as the incentives remain what they are, the machine will grow. As we examine the trajectory of BlackRock's rise, a striking realization emerges. The company's power is not the result of intentional empire building, but rather a natural byproduct of modern financial mechanics. In other words, BlackRock is not an anomaly. It is the inevitable outcome of a financial world optimized for efficiency, automation, and scale. In earlier eras, financial power came from controlling gold, railroads, oil, steel, or land. These were physical assets that depended on geography. But in the 21st century, the ultimate resource is capital flow, the invisible currents that move through global markets. Whoever directs these flows shapes industries, nations, and technological evolution itself. BlackRock sits at the nexus of these flows. When trillions move through passive funds, they move through BlackRock. When pension systems rebalance, they do it through BlackRock. When governments restructure debt or manage reserves, they consult BlackRock. And when institutions model systemic risk, they rely, knowingly or not, on BlackRock's algorithmic frameworks. This creates an environment where BlackRock is no longer just a participant in the market. It becomes a gravitational center. Companies orbit around it. Governments gravitate toward it. Regulators accommodate it. And like gravity, its influence is not always visible, but it is always present. Consider the cultural shift that has occurred inside the corporate world. Executives once feared activist investors, individuals or funds that accumulated shares to agitate for change. But now the more powerful force is passive giants, whose votes can reconfigure boards instantly. This means CEOs carefully anticipate BlackRock's preferences. Entire corporate strategies are presented through the lens of what BlackRock considers prudent, sustainable, or aligned with modern governance standards. Board candidates are screened for alignment with stewardship principles. Compensation committees adjust metrics to satisfy institutional guidelines. Investor relations teams tailor messaging specifically for passive asset managers. This is not mere influence. It is structural conditioning. A generation of corporate leaders now thinks in terms of institutional approval. But what makes this unprecedented is not just the scale of influence, it is the near total opacity. Ordinary investors have no visibility into BlackRock's internal deliberations. The stewardship teams that cast millions of votes operate without electoral accountability. Their decisions shape companies that produce food, medicine, technology, energy, decisions that affect billions of people. Yet the public rarely knows how or why these choices were made. In theory, BlackRock acts in the best interests of investors. In practice, the definition of best interest is left to BlackRock itself. If BlackRock believes long-term risk reduction requires climate standards, companies comply. If BlackRock believes diversity data reduces governance risk, companies collect it. If BlackRock believes capital discipline improves returns, companies slow expansion. The public does not vote on these priorities. Policymakers do not approve them. They emerge from the internal logic of one institution. This raises a deeper philosophical question. At what point does a private institution become a governing institution? Governments issue laws, but BlackRock issues expectations, and corporations treat both with comparable seriousness. BlackRock may not have legal authority, but it has economic authority, which in the modern world can be even more powerful. If a government writes a regulation companies dislike, businesses lobby, litigate, or resist. If BlackRock signals disapproval, companies simply comply. The risk of losing institutional support is more frightening than a regulatory fine. This inversion of power reshapes the relationship between democracy and capital. Lawmakers debate policy. BlackRock enforces policy through capital allocation. The public votes for representatives. BlackRock votes for board members. One system operates through elections, the other operates through flows. And yet, the public narrative insists that the free market remains intact, that competition shapes outcomes, that consumers drive innovation, that corporate governance is decentralized. But beneath the surface, the structural reality is different. Competition is muted. Innovation is constrained by risk models. Governance is centralized among a few institutional stewards. Corporate priorities are harmonized across industries. This is a market designed for stability, not dynamism. And stability, paradoxically, brings its own risks. When so much capital is concentrated in passive vehicles, markets can become disconnected from fundamentals. Companies may remain overvalued simply because their index weight guarantees constant inflows. Conversely, sectors outside the major indexes may struggle to attract capital, even if they are strategically important. Market inefficiency becomes embedded in the system. Passive investors assume markets remain functional because active investors create price discovery. But what happens when active investors shrink to a minority? What happens when passive flows overwhelm the analytical engine of capitalism? These questions matter because passive investing is not merely a trend. It is a structural transformation. Once people experience the simplicity and low cost of index exposure, they rarely return to active strategies. And so, year after year, trillions more shift into the hands of the same three firms: BlackRock, Vanguard, State Street. Three institutions, one system, a new financial order. Now consider the possibility of crisis. If the global economy enters a severe downturn, triggered by debt instability, geopolitical conflict, or technological disruption, passive funds could experience large outflows as individuals seek liquidity. Simultaneously, Aladdin's risk algorithms might recommend de-risking across numerous institutions. The synchronized selling pressure would be unlike anything in financial history. Markets could decline not in waves but in cascades. Liquidity could evaporate, and governments, lacking operational capacity to intervene directly, would again turn to BlackRock. Each crisis increases dependency. Each intervention solidifies the institution's centrality. Each bailout expands its role. Eventually, this dynamic creates a self-reinforcing loop in which BlackRock becomes the de facto stabilizing force of global capitalism. Not because it sought the title, but because its infrastructure is the only one capable of operating at such scale. This raises the question: if a private company becomes as essential as a central bank, should it be regulated like one? Should it be accountable like one? Should it be transparent like one? Or would such regulation undermine the efficiency that made it indispensable? This is the paradox of modern finance. We rely on institutions whose power arises from the very lack of oversight we fear. If BlackRock were regulated like a public utility, it might lose its operational agility. If it were broken up, markets might become more fragile. If it were left unchecked, its dominance could become irreversible. There are no easy solutions. Some propose transferring voting rights from asset managers to individual investors. In theory, this decentralizes control. In practice, few investors would participate, and those who do might be swayed by misinformation or lack expertise. Others propose restricting asset managers from voting at all, forcing companies to rely on direct shareholder engagement. But this could lead to governance chaos. And still, others argue that the only viable solution is to accept the new system, to embrace institutional stewardship as a modern necessity, analogous to how society once embraced central banking. But that conclusion carries profound implications. It means conceding that a private institution will effectively guide the corporate and economic direction of an entire nation, or multiple nations, without direct democratic oversight. It means acknowledging that capitalism, as traditionally conceived, no longer exists. Instead, a new structure has emerged: managerial capitalism, where capital is owned by many but controlled by few; algorithmic capitalism, where markets reflect models rather than human analysis; concentrated capitalism, where ownership consolidates across industries. And at the center of this transformation sits BlackRock, not as a villain, but as an inevitable outcome of the world we built. Its power is quiet, technical, systematic. Its influence is diffuse, yet decisive. Its control is indirect, yet overwhelming. BlackRock does not need to command corporations. Corporations adjust themselves around BlackRock. It does not need to dictate policy. Governments craft policy that aligns with BlackRock's frameworks. It does not need to overpower markets. Markets evolve to suit BlackRock's algorithms. And unless structural changes alter the trajectory, this concentration will intensify each year as global savings accumulate in passive funds. By the mid-2030s, BlackRock's stewardship could influence decisions affecting artificial intelligence regulation, energy transition, biotechnology, infrastructure, and global trade. Its guidance could shape which technologies thrive, which industries consolidate, which companies rise, and which fall. It may become the silent architect of the global economy, a private institution that governs through ownership rather than office, through capital rather than law, through incentives rather than commands. And what is most extraordinary is how quietly this revolution has unfolded. No marches, no elections, no coups, no dramatic speeches, Just a slow, steady shift of trillions of dollars into index funds, automated risk systems, and corporate governance frameworks. A peaceful, almost invisible transfer of power. BlackRock did not seize control. The world gave it control, one retirement account at a time. And now, as we stand in a financial order shaped not by political ideology, but by algorithmic allocation, the central question becomes, what happens when one company becomes the keeper of capitalism itself? The answer to that question will define the next era of global economics, and perhaps the next era of governance.